Highlight of the day, if you take a look at the screen on the left, United Healthcare, Boeing, price ladders for both, but we're not going to discuss those. I want to show you the downside in a moment. If you were short, when to scratch your head and maybe cover that short. If you were bullish looking for a bottom, if you were, where's the moment to trigger you in the trade to highlight a price in real time that could create a bounce? And so if we play this video, you're going to see this downside action here. I want you to look on the right screen. You start to see longs get thrown off the boat. See all these little green profiles right in here? This 241 number showing you that longs puked. What do longs puke with? Well, let me pause it. What do you use to puke a long? Generally a sell stop, right? So does most of the rest of the world. When you exit a long trade for a loser, generally you're throwing a sell stop below the market. If they get elected, we identify it and we call it longs puking. We highlight it with a green profile. Generally, if there's less longs because they get stopped out, there's less sellers because we know if you're a long, you're a seller. If you're not a long, you're no longer a seller. Less longs, less sellers, less sellers. Price has an easier chance to go up. It's kind of what's needed for the price of anything to go up. Less sellers. So you could see this wicked bounce. Now you have to be in a position to buy it, either to cover your short if you were short on this break, or you're bullish. So you're looking to buy it to open up a long position. And you want less competition. And if you're looking to get long, that competition would be other longs. Well, they just puked right there. And then you get the bounce. Now, this is real time order flow, real time analysis, what everybody is weak at or weakest at. And some people I muted on accident. Most people don't put themselves in front of tools to give them a chance to read the real time, and then it just becomes random and a guess. Another thing happened here. Keep your eyes focused. So I'll play it again. So not only do a lot of longs get thrown off the side of the ship, and puke is a word that was used slang back in the day to describe someone exiting a trade. But do you see all these shorts that came in here? These shorts come in. The laser, which is this line right here, went from green. See, it's green, 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 green to red. Let me pause it and show again. When it goes from green to red, that means it goes from more longs in the market to more shorts in the market. Why would you want to see more shorts come in if you're long or if you just got long? Because if someone's short, what are they to cover that short? A buyer. Don't you want to see a lot of buyers that have to buy it if you're already long? Because that's what you need for the price to go up. You need more buyers. You need as many buyers as you could possibly get, have, want. That's what you want if you're long. And shorts equal buyers. More shorts equal more buyers. If I play it, watch this red pop up in here. This is our OPP. Boom, pops in there, flips the laser to red. Those two things either get you to cover a short if you're a short or open a long if you're a bullish. Things to focus on when reading order flow. Because if you're not looking at, and I just pause it again, if you're not looking at different number stats tools, charts to try domes, whatever, to try to read order flow, then what do you, I mean, if it's not this that you're looking for when reading order flow, then what is it that you're looking for? Are you looking for what people already did or what they have to do? Because what people have to do is what drives price up or down, what they have to do. If they want to do it, fine. If they have to do it, even better, because that's where emotion comes from. I don't know about you guys, but after I get short, I have to buy it at some point to cover that short. And so does everybody else who just gets short. If I was long and I finally said uncle and got stopped out, I'm no longer trying to sell it because I just sold it and puked that trade. That's what a lot of people down here would have done. When there's less longs, there's less sellers. Let's draw it up. If a long equals a seller, a future seller, then less longs would equal less sellers. Correct? Makes sense? If longs equal future sellers, then less longs equal less sellers. Now come to the shorts. If more people are short, well, we got to start with this. What do shorts equal? Future buyers, right? After you're short, are you a buyer to cover that short? Absolutely. So if shorts equal buyers, then more shorts equal what? More buyers? Indeed, more buyers. What do you need for the price of anything to go up? Less sellers, more buyers. You've got the two necessary elements for the price of anything to go up. More buyers, less sellers. More buyers than sellers. But you really get fired up if you find that moment where this dynamic flashes quick. The faster you are at recognizing these dynamics and when they occur, the faster you're going to react. And it's going to seem like you're faster, but what actually happened is that you just slowed everything else down. That's why you have to trade what you see, not what you think. And too many people get into this business overthinking. At some point, your training has all done that thought, and you are technically thinking, but what you're really doing is reacting to the training that you have. You know what you're looking for, you know what it means. Now you're truly reading order flow instead of just looking at a bunch of numbers on a screen, which is essentially what footprints are and what all the numbers on a dome and a price ladder are. Just a lot of numbers of activity that may or may not take place. You don't know where it's coming from. Are they buyers that are spoofing? Are they buyers exiting along, entering along, opening a short, closing a short, whatever? Keep it simple and understand that longs equal sellers, shorts equal future buyers, and this little equation I just threw up here. And that's what you're looking for. And if you're in the market, meaning you're short, and you're actually getting paid and you're trying, where should I get out? Where should I get out? And let's say you were going to get out at this level down here for some other reason. That was your target. Doesn't it suck if it gets close to your target and bam, runs way right away from you and back to where you got in? How does that feel? Not too good. And look how close you were to getting out. But if you were able to qualify that this is no longer an arbitrary price that you put in there to cover your short to make money, and you adjusted it because of what you saw in the market, now you're trading.